From Vero Beach, Florida, it's the Money Nation Show. Hi, I'm Ed Gardner. Welcome to the Money Nation Show today. We're on the Florida show throughout Florida, and we're also online throughout the whole country. Thanks for everyone being here. It's a beautiful day here in Vero, 80, 84 degrees, sunny out, beautiful day. Today, we have Doyle Gustus, Managing Director and President of Cornerstone Select Advisors. Mr. Gustus has 38 years of experience in the investment business, has held upper management positions with national and regional brokerage firms. His focus is on value-based metrics, help managers and corporate executives define and develop valuation tools that help define profitability measures. Good morning, Doyle. Thanks for being here.
Hey, Ed, thanks. Appreciate the opportunity to be with you today.
Could you tell me a little bit more about Cornerstone?
Sure. We are a registered investment advisor. We're based in St. Louis, Missouri, and have been in St. Louis since the firm was established in 2008. We manage multiple client objectives as required by our customers. Our management style is to the objective of the customer.
Can you tell me a little bit about the type of clients that are looking for your services?
Sure, Ed. We're an SMA manager, separate account manager, that caters to high net worth individuals and institutional clients. The work basically, as you have mentioned, is value-based. And once the objective is established, we set the criteria for the selection of assets and the class of assets to meet the objective. We monitor it. We continue to research the holdings, and we're looking to do that over a longer period of time. So we're constantly monitoring the process.
Doyle, how does this work, and could you explain the valuation concept?
Sure. We spend, Ed, an inordinate amount of time analyzing companies that we're investing with. Over the years, we found that to accomplish the long-term goals that we would like to accomplish, that we need to get the valuation correct. That's the most important thing. And if we do that, volatility of the holdings in the short run really is just nothing more than a short obstacle to achieve the goal that's been set by the objective over a long period of time. We're constantly analyzing corporate performance of the holdings, and it's built around 6 basic principles. Those principles basically are management's execution, cash flow analysis, capital deployment, shareholder value, accounting distortions, which can happen in different industries, business value versus market value, which in normal parlance is intrinsic value.
Well, that's a lot to take in at one time. How about if we walk through each one?
Great. Management execution. The first one is basically how well does the management team allocate capital to projects that are specific to the business. Either that could include buying their own stock. That could be different projects that management feels like they want to invest in. So we want to see what the return is. We want to see how long the return is going to take, and what the average return on the management decision they make, and how much risk was taken when they made it. Cash flow is a little different issue. Investors in today's world, Ed, quite honestly, focus a little bit more on EPS, but depending on the business, cash flow is very, very important, and cash flow and earnings are 2 different things. Earnings can be a very poor proxy for economic value over time, and sometimes it fails to reflect really what the true return is to the customer or to the business. All investors, Ed, should be asking themselves some simple questions. What is the cash flow of the business? How much cash does it take to generate a unit of invested capital and the return on that capital? And is the cash flow increasing or is it decreasing over a period of time? Those are basically the most important parts of the cash flow part of it. As far as capital deployment, we want to know how much capital is required for the business to operate effectively. How much capital does the company use in its operation? And that's different from the execution mentioned previously about cash flow. Does it grow over time? And if it does, how much? And that comes to the next premise, which is the shareholder value. We want to see the capital deployment of the firm generate a shareholder return. So in the current environment, what we should really ask is the investor able to pay or the expected return, and if the company is, how do they do it? What is the return, and what's the period of time of how that return is paid to the shareholder? Has the company paid the shareholder over a long period of time? And what is their average weighted cost of capital? So the last two are very important. One is the accounting distortions. Accounting distortions are different for different types of industries, but we don't want them to confuse the value drivers. Accounting rules change with asset life, age, what types of leasehold improvements may be made. The capital structure, inflation also contributes to some of these distortions, so you need to be able to understand those and factor them. For example, R&D costs are expensed immediately on the balance sheet. Operating leases don't appear on the balance sheet. So those are things that are going to affect some of the metrics in the valuation process. Business value versus market value is the last part of it. And what we really want to do is identify the dislocations that we discussed above there to arrive at a true business value while analyzing the intrinsic value of the revenue, sales, and cash flow. The intrinsic value basically is going to tell us basically how much that stock could be valued in the future.
So Doyle, how then do you evaluate the investment you're making given your research and analyzing methods?
Well, what we do, Ed, is we've developed spreadsheets over time to cover hundreds of metrics that we use, depending on the industry, to help define the companies that are deploying the capital and building positive returns for shareholders. They provide the most useful metrics that enable us to value the company and how they're doing and adjusting accounting irregularities and market-derived valuation.
Doyle, what do you think investors should be evaluating today, given where we are in today's economy and interest rates?
Great question. Rising rates seem to be on everybody's mind right now. How do we adjust the expectations as rate increase while the market's at an all-time high? Do we buy the dips? And if we do, when? Do we switch from growth to value? Those kinds of questions are really paramount right now for people. The biggest issue, as far as we understand by running the valuation metrics that we do, is to understand as valuations start to compress, and this is on people's mind, in the forefront of their mind at this point in time, as these values compress because of the higher rate of expectations, how does that affect the pricing mechanism and the expectations? We know basically in these kinds of environments that PEs are likely to compress at the same time as rates increase. So as that multiple begins to compress, what happens to the earnings revisions going forward? Many times what will happen is as those earnings start to compress, we need to know how the forward or the future earnings estimates are coming from analysts. And that is going to obviously tell us if the revisions are greater than the multiple compression, the stock remains attractively priced, and maybe it may be a buying opportunity. If all of a sudden the PE start to compress, those earnings expectations start to compress with them, then what happens is you will be in a position to where you probably will see price depreciation or deterioration. So the purpose here is to provide the customer over a period of time with support and research that gives them the expertise and understanding of actually what's going on at the time. And that gives people confidence. And our hope is that if it keeps, that process will help keep them on track, and it'll put them in a position to where they have confidence in what they're doing.
Fantastic. We're going to take a quick break. Remember, listeners, any questions at all about your investments, about your 401k, your IRA, any questions at all, feel free to give me a call at 518-255-8854, or you can always email me at edgardner@cutterco.com. We'll be right back.
All opinions expressed by Ed Gardner and or his guests on the Money Nation show are solely Ed Gardner's and or his guests' opinions and do not reflect the opinions of Cutter & Company or any of their affiliates. You should not treat any opinion expressed by Ed Gardner and or guests as a specific inducement to make a particular investment or follow a particular strategy, but only in as an expression of their opinion. Ed Gardner's and his guests' opinions are based on information he considers reliable, but neither Cutter & Company nor affiliates and or subsidies warrant its completeness or accuracy, and it should not be relied upon as such. Always talk to your financial advisor before making such decisions.
Welcome back, everyone. Doyle, everywhere we've been hearing the last several days about the M2, the money supply, and how it's expanding, I think 4 or 5 times the average rate, really exploding. People think it's going to cause inflation. What's your feelings? What's your thoughts about that, Doyle?
Oh, that's a great question too, Ed. I think people sometimes make observations about the M2, and I think that they don't realize how broad of a measure that is. M2 basically is cash, it's checking accounts, it's CDs, it's money market funds, it's mutual funds. That's a pretty broad stroke in terms of the amount of liquidity in the system. It also includes other short-term instruments. So that's very, very broad stroke when it comes to understanding what kind of liquidity is put into the system. There is no question that it's larger. There is no question at this point in time that it's expanded rapidly. The real question becomes, people associate that many, many times with inflation because of the expansion of the instruments themselves. That's really a pretty big leap of faith to make because inflation really is going to be driven by banks that need to lend the money, that have the capacity and need to lend the money. They're not doing that now. Consumers need to spend the money. I'm sure that they will spend more money, but they're not spending the money at the rates that we've seen in the past. And corporations have tremendous amounts of cash on their balance sheets, and they need to spend that money. Those 3 things have not yet happened. So to make a forecast that inflation is obviously going to start raising its head quickly, I think is a little bit of an overstep. It could happen over a longer period of time. We may see that, but I don't think there's any absolute evidence now. And I think the Fed is seeing that. That's why they're on pause Right now, they're not doing anything specific or changing their positions at this point in time. So I think that it's just a little difficult to understand why inflation is going to start rearing its head quickly and explode when I think that the premise is just not founded that it's going to happen yet.
Well, you're a value manager, and in the last 2 years in the market, we've seen the FANG stocks and a handful of others. There have really been 8 or 10 stocks that have really pushed the NASDAQ and the S&P, for that matter. Value this year is doing much better. What do you think the rest of the year is in store? How we're going to do the rest of the year and maybe the following year?
Well, I think values basically is a reversion to the mean at this point in time. Value stocks basically have a little bit more stable, longer term history of earnings and earnings expectations. So of course they don't grow quite as fast as some of these higher end, the FANG stocks that you mentioned. But the valuations are relatively low. For an example, XYZ company right now could be growing at a rate of, let's say, 4 or 5%, which is to some people's thinking that's below average or a substandard rate. It may not be at all for what they do. And you also might find that revenue base on the size of the capital investment that they have might be a very good way to look at how effective they will be able to generate earnings over a long period of time. So what you may see is that when you start going through and doing the calculations of the metrics that are involved, what you will see is that based on the price where they are at this point in time, that same company, XYZ, should have sales growth of maybe minus 1% or at zero. So if they have revenues that are growing at the rate of 4 or 5 or 6%, that basically is a pretty good indication that that price is extremely undervalued and will revert to the mean of its historic growth over a long period of time. That's what we're seeing now. So for that reason, or that's one of the reasons, that's why you will see value stocks, in my opinion, do exceedingly well going forward. And of course, as much as anything else, it's going to be a selection process of finding those good valuations and buying them so that in the future, next year or two, you'll be able to take advantage of the return generated by them.
I noticed in your portfolios on the income side, you use preferreds versus bonds. Can you tell me about why you use preferreds and what you like about them over bonds?
Well, we use a great question. We use the preferreds, Ed, that basically are qualified dividends. We usually don't use many. We have a few, but we don't use very many preferreds that are not qualified. The reason for that is when you get into this interest rate discussion, bonds are going to give you the stated rate of return or the coupon rate over a period of time. They're not going to appreciate in value very much. They could decrease in value if rates go too high, but basically they're priced. The pricing mechanism for those bonds is basically off the 10-year Treasury or 30-year Treasury, whatever, the riskless rate of return. Preferreds are priced basically in the same way, but those preferreds have a tax ramification to them with that qualified dividend that gives people a little bit more spendable income. Some of those preferreds that have that dividend exclusion or qualified dividend will be taxed at a much lower rate, so the net effective return of the investor is higher. Of course, people have to understand that it's not the same risk profile as a corporate bond, but in certain circumstances with some institutions that have those preferreds, it's our opinion, quite honestly, that the risk profile is really no greater than the bonds. Now, the preferreds are considered junior debt, but they also carry investment grade ratings, and we've been participating in those preferreds that have investment grade ratings. So if it's let's just assume it's a 4 or 5, let's say a 5% coupon, and it's compared to a bond that has a 5% coupon, that preferred is going to give the investor more net spendable dollars in his pocket because of that tax ramification than the bond will. And the price fluctuation of the asset should be comparable as long as it's an investment grade preferred. So the reason why we use them is because those preferreds are paying an excellent rate above the 10-year right now. So we're in a pretty good position with that tax benefit.
Interesting, very interesting. Makes a lot of sense. Doyle, the last question is, yesterday we had the Fed Chairman Powell testified at the House, and it was on Bloomberg yesterday about rates. What are your, lastly, quickly, what are your your feelings on rates, the 10-year, this year, next year?
Well, I think the best way to look at the rates is when I'm in that process of looking at rates, Ed, I use the dot plot of the Fed's dot plot. I think that the dot plot is the forward pricing mechanism for the marketplace in risk-free rates of return. It's treasuries. The indication is at 2%. I don't believe that we're going to go much higher than 2% for the rest of the year. I would be surprised if we did. I've heard all kinds of commentary and questions about a 2.5% or maybe 3%. That's not what the dot plot is telling us on Bloomberg at this point in time. It's basically telling us 2%, and basically, from my perspective, 2% is priced into the market right now. So it's not pricing anything higher. So I think that that's the only assumption that you can really make. That does not lead itself to much higher rates going forward. Obviously, it just basically puts kind of it's a cap, I guess, if you want to call it that, of around 2%. And you got to understand where that dot plot information is coming from and how they arrive at it. It's really very simple. It's the balance of all the Federal Reserve governors in the system of the Federal Reserve System that is giving their opinion. So basically, it's the other Federal Reserve participants that are giving their opinion, and they're looking into the future. They're averaging it. That's where you're getting the dot plot numbers from. So it's schooled folks that know what they're doing, that are all very qualified people. And the dot plots, again, simply is coming out at 2% through the year. So
nice. That makes a lot of sense, you know.
So I think we're in good shape.
Beautiful. Doyle, well, thanks a lot for joining us. Hopefully have you on again. Look forward to seeing you again, talking to you again.
Appreciate it, Ed. Thank you so much.
And remember, listeners, any questions at all about any of your investments, your accounts, 401k, your IRA, anything, feel free to give me a call at 518-255-8854 or email me at edgardner@cutterco.com. Thanks for everyone for listening to Money Nation.